If the government is collecting billions more in tariffs, why are your grocery bills and gas prices still climbing? This is the central question behind Trump Tariffs 2025. On paper, Washington points to higher revenues as proof the strategy works. But on Main Street, families see fewer dollars left in their wallets at the end of each week. At the same time, America's national debt has crossed a staggering $37 trillion. That debt acts like a weight on the economy, pushing interest rates higher and squeezing household budgets even further. And then there's Canada, America's closest trading partner, and a country now caught directly in the crossfire of these tariffs. A new 35% tariff on Canadian goods and penalties on transshipment are already changing how businesses move products across the border. For decades, U.S.-Canada trade was seen as a stabilizing force. Now, it's becoming a battleground where policies in Washington echo all the way down to supermarket shelves. This video will connect the dots between government ledgers, national debt, and the real costs felt in everyday American life. Because Trump Tariffs 2025 is not just an abstract policy, it's a story about your bills, your gas tank, and your family's future. Big picture: tariffs, markets, and debt. In April 2025, the White House rolled out a 10% baseline tariff on nearly all imports, a sweeping move that immediately shook global markets. Traders labeled it the beginning of a new protectionist era, and investors reacted fast. The Dow Jones and the S&P 500 tumbled in those first days as uncertainty spread across Wall Street and beyond. Funds began pulling capital, volatility spiked, and the phrase "Trump slump" became a headline almost overnight. But markets found temporary relief. Exemptions granted in the following weeks allowed certain industries to catch their breath, giving the appearance of stability. That calm didn't last. On August 1st, Washington doubled down, imposing a 35% tariff on Canadian goods not covered by USMCA and layering on a 40% transshipment penalty for companies rerouting products through third countries. The result was another jolt to equities, especially in industries tied closely to cross-border trade. For investors, the message was clear. Tariffs were not just a bargaining chip, but a long-term strategy. At the same time, America's debt picture was getting darker. By mid-August, the national debt passed $37 trillion, setting a record that directly impacts the cost of borrowing. As Treasury yields climbed, so did the rates on mortgages, auto loans, and credit cards. Families refinancing their homes or financing a new car quickly discovered their monthly payments had stretched beyond last year's budgets. It's a ripple effect few households can ignore. And while Washington touted tariff revenues as a victory, the credit agency S&P reaffirmed America's rating at AA+ with a pointed warning. Yes, those billions in new revenues may offer a short-term cushion. But tariffs are not a cure for structural debt growth or ballooning interest payments. In other words, the government ledger may look healthier for now, but the underlying U.S. debt crisis continues to weigh on the economy. For everyday Americans, the big picture is unavoidable. Tariffs shake markets, debt drives costs higher, and the supposed cushion is no shield against rising household bills. USMCA exemptions, the gatekeeper. When people hear the word tariff, they often imagine a blanket tax that applies to every single product crossing the border. But under the United States-Mexico-Canada Agreement, USMCA, the reality is much more complex. The key lies in rules of origin, detailed requirements that determine where a product is truly made. If a good contains enough North American content, it can qualify for reduced or even zero tariffs. If it doesn't, the levy can be as high as 35% under Trump Tariffs 2025. That distinction has made USMCA exemptions the true gatekeeper of trade. According to recent data, anywhere from 56% to 90% of Canadian exports have avoided tariffs, depending on the industry and the month measured. This gap shows how compliance is not just about politics, it's about paperwork and proof. The auto industry is the clearest case study. A car assembled in Ontario with North American steel, electronics, and parts can roll into the U.S. at a zero tariff rate. But if that same vehicle uses too many imported components, the cost jumps instantly, triggering the full 35% duty. For major manufacturers with global supply chains, the adjustment is painful but manageable. They can hire compliance teams, restructure contracts, and absorb delays. For small and medium-sized enterprises, SMEs, it's a different story. Many lack the resources to navigate complicated forms, certification rules, and origin audits. As a result, they are far more likely to fall on the wrong side of the exemption line. That's why in 2025, USMCA exemptions aren't just legal fine print. They are the gatekeeper deciding who pays the tariff and who escapes it. For Canadian exporters, the difference can mean survival or shutdown. Where households feel it: grocery, gas, and daily life. For most families, the true cost of tariffs isn't measured in billions of dollars or stock market charts, it's measured at the checkout line. One of the clearest examples comes from the aluminum tariff, now set at 50%. Every can of soda, beer, or canned vegetables relies on aluminum packaging. Producers now face higher costs, and those costs inevitably flow down to shoppers. The most symbolic case is Arizona iced tea, a brand famous for holding its price at 99 cents for decades. Under current tariffs, even that iconic price point is under pressure. It's a reminder that when trade policies shift, the effects land in places as ordinary as your corner convenience store. Multiply that across an entire grocery trip, and the math becomes unavoidable. A family that spent $200 per week on groceries in 2024 is now paying closer to $230, or even $240 in 2025, without putting any extra food in the cart. That 15 to 20% jump may not sound dramatic on paper, but for households living paycheck to paycheck, it means tough trade-offs, less savings, fewer extras, and sometimes choosing between bills and basics. And it doesn't stop at the grocery aisle. Energy costs are equally vulnerable. The United States remains deeply dependent on Canadian oil, especially heavy crude that U.S. refineries are configured to process. That reliance makes fuel prices highly sensitive to political maneuvering. Any disruption, whether it's tariff disputes, transport bottlenecks, or diplomatic friction, quickly translates into higher gas prices at the pump. Electricity and utility bills follow suit, since energy costs ripple across the entire economy. For wealthier households, higher bills may be an inconvenience, but for middle and lower-income families, they represent a direct hit to financial security. The story of Trump Tariffs 2025 is not abstract economics. It's the shrinking grocery cart, the rising gas receipt, and the growing squeeze on the American middle class. This is where policy decisions in Washington collide with everyday life. Soft pressures, boycotts, travel and consumer behavior. Not all the effects of Trump Tariffs 2025 show up in financial statements or government revenue charts. Some play out quietly in the daily choices consumers make. One of the sharpest examples is in Canada, where shoppers are pushing back through boycotts. Sales of American-made spirits have dropped by more than 60%, cutting deep into a sector that links U.S. agriculture, distilleries, and packaging. Wine exports have also been hit, reminding us that even lifestyle products are tied to trade flows. For farmers, grain suppliers, and small bottling plants, these lost sales represent jobs and income that won't be replaced overnight. Travel tells a similar story. Cities like Las Vegas and Miami, long favorites for Canadian tourists, are now reporting noticeable declines in visitors. What starts as a decision to vacation elsewhere ripples through hotels, restaurants, shows, and the countless service jobs that depend on steady tourist flows. For many businesses, these soft frictions are harder to measure, but just as damaging. They don't look like tariffs on a spreadsheet, yet they change consumer behavior in ways that reshape demand. A family choosing Mexico or Europe over Florida may not make headlines, but when multiplied across thousands of households, the losses add up. That's why these consumer-driven pressures matter. They demonstrate how politics at the top filters down into the everyday economy, creating consequences in industries that never expected to be caught in the tariff crossfire. In 2025, boycotts and shifting travel patterns are proving that the true impact of tariffs isn't confined to customs forms. It reaches deep into culture, habits, and livelihoods. Canada's countermove: diversify, not divorce. For decades, Canada has relied heavily on the United States as its primary export market. In 2024, roughly 76% of Canadian exports flowed south across the border. By mid-2025, that figure has slipped closer to 68 to 70%, one of the sharpest drops in modern trade history. It signals a deliberate push by Ottawa to diversify exports, reducing dependence on a single partner. One pillar of this strategy is infrastructure. The Port of Prince Rupert in British Columbia is expanding capacity, designed to capture more trans-Pacific shipping and connect directly to Asian markets. New logistics hubs and rail links are being built to move goods more efficiently east and west, bypassing the traditional U.S. corridors. At the same time, Canada is strengthening ties with Mexico. High-level meetings have focused on joint energy projects and infrastructure cooperation, from pipelines to renewable grids. Canada's powerful pension funds, which control trillions in assets, are exploring investments in Mexican ports and clean energy, laying the groundwork for deeper integration. But diversification is not the same as divorce. Geography still matters, and the U.S. remains Canada's largest trading partner by far. Even as Ottawa looks outward, American consumers continue to drive demand for Canadian oil, minerals, and manufactured goods. The counter-strategy gives Canada leverage. It shows Washington that alternatives exist, even if those alternatives will take years to fully mature. In the context of Trump Tariffs 2025, Canada's message is clear. It will adapt and expand its options, but it is not walking away from the U.S. market. It's diversify, not detach, a recalibration of reliance, not a severing of ties. As the dust settles on Trump Tariffs 2025, there are 4 critical signals to monitor in the months ahead. First, watch the scope of the next round of exemptions. They will determine which industries get relief and which remain under pressure. Second, follow how Canada and Mexico respond with long-term strategies, from trade diversification to countermeasures that shift regional supply chains. Third, keep an eye on interest rates and the path of America's $37 trillion debt, because higher borrowing costs will continue to flow straight into mortgages, car loans, and credit cards. And finally, track the next updates from S&P and Moody's credit ratings, since their judgments shape investor confidence and borrowing costs worldwide. The big picture is simple. Tariffs may provide a short-term cushion for Washington's budget, but the long-term costs are being paid by American households at the grocery store, at the gas pump, and on their monthly bills. So here's the question for you. How much have your bills gone up in the last 3 months? Drop your answer in the comments and let us know where you're watching from. Don't forget to like, subscribe, and share, because understanding these shifts is the first step in protecting your wallet from the global trade storm ahead.